it is becoming difficult for most investors to find the right funds to invest. Should you be prioritizing your financial goals or should you take tactical calls? We need a perspective for sure to take those important investment decisions. And to give you that perspective today, I have with me Aniruddha Bose, Chief Business Officer, Finage Advisory. Aniruddha, welcome to the show and thanks so much for joining us today.
Hi, everyone, and thanks a lot, Shimona and DSP for having us over.
Thank you. So before we start the conversation, request all viewers to share the questions that you might have in the chat box, and we shall take it up towards the end. So Aniruddha comes with close to 2 decades of experience in the Indian financial services industry. But we would want to know more about you, Aniruddha, and Finage Advisory. So would you take us through your journey and Finage as well?
Sure, Shimona, as quickly as possible. So I've been in the industry since 2004. I started off in retail banking, then I had a stint in wealth management, and then with Finage, this incredible journey right from the inception of the company. So about Finage, I'd like to believe that we've built some fabulous technology which actually enables people to deliver a collaborative experience, a collaborating investment journey to clients. And because we've always believed that while automation is great, fabulous, it is people who define the ultimate investing experience, since investing is an emotional decision. So our entire business has been structured around that. And so that's what Finage is.
Wow, that's great. So how large is the company and how many investors do you guys manage? And if you can also tell us a little bit about the profile of investors.
Okay, sure. So we've got about 20,000 odd clients. They're spread across 1,200 cities. We don't meet clients physically. We like to call ourselves bionic because we're tech enabled. And these clients are spread across 75 odd countries. We've got 50 odd people who help these clients. We manage about 800 crores of goal-based investments. We deliberately call it goal-based because all our investments are linked to goals. When you talk about profile, well, we don't have a demographic profile in place, but we have a very simple criterion for being a Finage client. That is, you've got to be a serious investor. You've got to be investing with purpose. So no speculators allowed. We've actually got screening tools which enable us to educate people on the kind of behavioral biases that can hold them back. And we try to create a more serious investing experience with the aim of achieving financial goals in the long term.
That's quite simple and straightforward. So Aniruddha, we have seen most investors when they start their investment journey, especially into the equity investing, they begin with tax-oriented funds or tax saver funds rather than other equity funds. So is it the same for Finage as well?
You're right in a way, because tax saving, of course, is a very, very important financial priority for a lot of people. With us, it's actually not the case. It's pretty much the reverse. Even if people come to us with the goal of tax saving, we are averse to just starting off an investment. So our philosophy is to not make ad hoc investments, to link them to a goal. So we generally don't start investments without a proper plan in mind, especially if they're equity linked. And of course, we'll talk about that later in terms of how it helps clients. So even if clients do come to us with a goal of saving taxes, we make it a point to define goals and objectives. And even if we have to, we often link those tax saving investments to those objectives. But we certainly don't start off with just a pure tax saving investment and then move on to the other elements. It's actually the reverse. We start off with a plan, a well-structured plan, and then we link those tax saving investments to those particular objectives.
Right. So with so many funds available to all the investors today, how does Finage evaluate the right equity funds for their investments? And we would also love to know what is the process that you follow when you suggest funds to your clients?
Right. So in a nutshell, Shimona, we don't believe that more choice is better when it comes to equity funds. In fact, having too much of a choice can sometimes prove detrimental. That's our philosophy. So we've got a very neatly curated whitelist of funds. We don't pick and choose from the entire universe of funds. We're not a supermarket. For us, our guiding philosophy, especially for something as volatile as equity investing, is that the why and how of investing matter a lot more than where you invest. By that, I mean, I'm not undermining the importance of selecting funds for sure. But what I'm trying to say is, if you select funds, if you select the best funds, if you by chance are able to predict the best performing fund for the next 3 years, but you don't have a proper investing process in place, if you've not understood the risks, if you've not mapped them to goals, at least in our experience, we've seen a lot of these investment journeys just break, they fall by the wayside, and then it just becomes a moot point, because selecting the best fund without actually continuing and seeing it through to the end of the journey is in the end not something which is going to be useful for anyone. So our process, as you said, so we begin with a plan, like I already mentioned. We focus more on the process and the journey. And once we've identified those, that's when our process of allocating funds begins. It's actually the very last step. So the most meaty discussions for us happen more around financial priorities, expenses, cash flows, objectives, goals. And it is only once all those are identified that we can actually discuss with clients what funds are best for them and their particular life situation and objectives. So once we come to that point, I did mention we've got a curated set of funds that we offer, not the entire universe. We actually focus a lot more on the AMC. So for us, our process begins top down, not bottom up. It's not like, okay, here's the universe of funds, here's the entire list of few hundred odd funds. Which one should I pick? It's let's start with the AMC. Let's understand their risk management framework. What due diligence do they do? How robust is their team? How robust is their fund manager? What kind of processes do they follow? We also keep monitoring certain red flags. Those may be top level exits, too much leverage. But to be very frank, Shumona, our 80% of our process, 80% of our focus is on the process. Like I mentioned, it's on the why and the how. And 20%, I would say, is on selecting funds. And even within that, we don't try to be heroes. For us, as long as we meet the client's objectives, which means if we deliver a 12% steady return, which is as per the documented plan, it is far better than selecting the best performing fund at all points of time. So we firmly believe that it's worked very well for us. Lots of our clients have met their goals and over lengthy periods of time, which is something I cannot say for a lot of people. And I think that's happened partly because we've selected the right funds, but also mainly because we followed the right investing processes.
Wow, seems to be quite a elongated process and a detailed one. You did mention about two things. One, of course, is that the entire conversation happens, I think, over telephone, right? That's what you mentioned. And yes. And you also mentioned—
Or
video conferences, right? Yeah. So would you want to share some of your experiences? Because it seems to be a little different than what's happening in the industry, where people would generally meet face to face. So would you want to share some of your experiences with us? How the clients would react, and when they've achieved their goals, how are you going to be tracking, and how are they going to come back to you? If you can just share some experiences of yours.
Well, there are so many. There are clients who've been stuck in fruitless insurance plans, and they did believe that they were on track to meet a lot of their critical goals, only to realize that they hadn't factored in inflation, or they just were too risk averse, and they were going to probably have a massive shortfall from their goals. And then once they underwent the process, it kind of served as an eye opener. They were able to reallocate portfolios. We have clients across India. It's very exciting, actually. So we've got people who are. I know we have a taxi driver who has accumulated some 35 odd lakhs with us over the last 4-5 years. He never invested in equities, and he never even understood what goals are. But slowly he warmed up to us, and he's a very, very goal oriented, goal focused investor now. And I must say, he's one of the people who didn't panic at all when portfolios fell so drastically a couple of years back. So that really validated our entire process, because people who've been first time investors, who've never really even tasted equity funds, having undergone the process, they were able to kind of automatically become seasoned investors, behaviorally speaking. So there are countless stories. I can just go on and on, but yeah. So
that's quite a fascinating story, because most of the time when we interact with with investors, the first thing that comes to their minds when they select funds is returns. In fact, most of them would say that that's the most important criteria. So do you think should it be this way, or what's your view on using past returns as a good selection criteria?
So Shumona, it's a double-edged sword. I'll be very honest. And there's been a proliferation of a lot of DIY apps and a lot of these websites which publish returns frequently nowadays. information is good, but I do believe that there's something known as information overload. In fact, it's a well-documented behavioral bias. You're a financial wellness coach. You're probably exposed to it all the time. What I've seen, at least what we've observed, is past returns are a very myopic way of evaluating a fund. So what most people I know do, especially the first timers, is they'll go to one of these apps or these websites and they'll sort quickly by 1 year, 2 year return, and they'll be enamored by it. Oh, wow, XYZ fund is given a 70% or an 80% return. And simply because they don't understand how securities markets work, they end up burning their fingers very, very drastically, because as you very well know, what goes up comes down. Everything moves in waves. Everything is cyclical, and ultimately, past returns are a lagging indicator. So are star ratings, by the way. So star ratings are all based on metrics that have already happened. So it's like saying that something has gone up in price, so let me buy a lot more of it, right? Which is exactly the opposite of what should be done. And this, unfortunately, over the last couple of years has created a bitter experience for a lot of first timers. While equities are such a fabulous wealth creation tool, right? We know that it's outperformed pretty much every other asset class over the long term, real estate included. If you go and if you just sort by past returns, and if you invest, what's going to happen is you're going to keep making losses and keep making losses. And at some point, you're just going to throw in the towel, right? There are so many examples, Shumona. Few of them come to mind. I remember in 2017, there was a massive rally in small caps. And as it so happens, when the smart money exits, it is the retail money that comes in. And that's the reason, because they're seeing everything through the lens of 1 year and 2 year returns. And all of a sudden they see, wow, 100% 1 year return must be fabulous, right? And then what ends up happening is you very quickly fall by 40, 50%. And the same thing happened in 2021. Post-COVID, small caps shot up, they rocketed ahead, only to correct very drastically. I've seen this happening, especially in sectoral funds, Shumona, and thematic funds. I know pharma went up a couple of years back, and it's when it went up drastically that it attracted a lot of retail money. Look at US tech. US tech shot up during the post-COVID phase, and a lot of these tech funds were launched. A lot of retail money went in, all based on past returns. Wow, the NASDAQ has given a 50% return. Must be fabulous time to get in. Except they don't understand it's probably the worst time to get in, right? And now the NASDAQ has fallen 30, 40 odd percent and is duly correcting. So what happens, Shumona, is if you base your entire investing framework on the myopic past return lens, you will constantly keep burning your fingers. And there'll be a time when you'll write mutual funds off as an investing tool, while actually the winners in the equity investing game are the contrarians, right? We all know that. They're the ones who get into something which hasn't done well. And so it's the exact opposite of what should be done, to answer your question.
Right. So then from the returns perspective, you're saying what should be more important rather than a point to point, or should we look at something called rolling returns? And if you can, talk about it a bit.
So you're right. So returns, you can't ignore returns. I mean, come on, we're in it to make returns, right? So Absolutely. You can't say invest in XYZ equity fund though it's given a poor return. We can't say that. The only thing is you've got to understand what returns actually mean. You have to put it in perspective. So when you talk about rolling returns, certainly a far better framework for evaluation. So what is rolling returns? So for example, if a fund has been around for 10 years, there are many 5-year periods in that 10-year phase, right? Multiple 5-year periods, from Jan to Jan 5 years, and Feb to Feb, so on and so forth. And so when you talk about rolling returns, it's basically a cumulative average of all these rolling periods, right? And I think that's definitely, if you have to consider returns, point-to-point returns are meaningless because, okay, let me ask you, is a 70% return good?
I mean, it's very subjective.
Extremely subjective, right? Absolutely. Now, is a minus 10% return bad?
Yeah.
Again, very subjective. What if the market has fallen by 30%? Correct. And my fund has fallen by just minus 10? Then it's a drastic outperformer. So point-to-point returns are meaningless. Actually, Shumona, even rolling returns are meaningless. I'll tell you why. Unless you compare them with something.
Okay.
Right. We will, of course, talk about risk later on, I think, in our discussion. But every fund has a different risk framework, right? So there are funds that invest into pure large caps. Those, I would say, are the least risky out of equities. Equities in themselves are a high risk category. But within equities, you've got small caps, you've got thematic, you've got sectoral, you've got all these different categories. So unless I compare the rolling returns from a large cap fund with, say, the rolling returns from the Nifty or the S&P BSE 500, I've just got a number. That number means nothing. In the end, I am paying a price for investing in a mutual fund, right? I'm paying fund management fees, I'm paying an expense ratio. So to get bang for my buck, I must get outperformance, right? So I have to compare the rolling returns from these funds with the rolling returns from the index, right? So that suddenly gives me a better perspective. So worst is that sort by 1 or 2 year return. Second, I'd say a step higher is rolling returns. And the best framework for evaluating any fund based on returns is maybe a 5 to 7 year period, first of all, for equities. So that automatically eliminates a lot of new funds, right? Take rolling returns over 5 to 7 year periods and compare them with the benchmark. And I would say a fund that has outperformed the benchmark on a rolling return basis for about 7 out of 10 times is definitely on a returns basis, can be labeled a fairly decent performer.
Absolutely. So, Anirudh, you also mentioned about the star funds, like you had highlighted. Similarly, we come across, jargons like flavor of the month fund. What's your view on those? And do you think it would be a good idea to select those funds?
No. So when your journey is long, so equities are a long-term investing journey, right? I mean, it's not a month or two. A lot of people misunderstand equities as a speculation tool, and I think that's where people go wrong right off the bat. Equities are not a speculation tool at all. There are equity mutual funds, especially. So there are far better speculation tools available, right? Go to a casino in Las Vegas. I think that's a better speculation tool. Or leverage. Buy some FNO, dabble a little. Those are speculation tools. So I think when you get into this flavor of the month mindset of always trying to pick the best performer over the next 1 year or 3 months or 4 months, I think it's the most dangerous thing that you can do with equities, because you've automatically benchmarked your long-term decision based on a short-term trend, right? And what happens is basically neither markets nor returns can be predicted, right? And I have so often seen, Shumona, that the biggest drops in a particular fund precede their best phases, right? Because I've seen that they're cyclical. A fund manager may have got one bet wrong, or for some odd reason, some of their stocks didn't realize value, right? I can't control when the market is going to realize the value of my portfolio. I may have made some fabulous investing decisions, but ultimately returns are a factor of the markets, right? So often people end up getting off the train and then they jump back on. And then what happens is they're prancing around as if on hot coals. And in the end, they end up missing the best phases of a particular fund's performance because they exited too soon. Multiple behavioral biases come to the fore. And in the end, the biggest loser is the investor. So that flavor of the month thing, I've never subscribed to. It is almost impossible, according to us, to predict which fund is going to perform the best over the next 3-4 months, or even 6 months, or for that matter, even the next 1 year, because there are so many variables in play when it comes to equities. I will allude to an example of a very old, I think it's one of the oldest blue chip funds. It was launched some 28 years back. It has a CAGR of 19%, right? Now, 19% is a lot. You know the impact of a 19% compounded average over 28 years. That means 1 lakh would have grown to 1.3 crores, right? Now, this fund has a 2-star rating, and it's been a compounder par excellence. But how many people do I know who've actually earned 19% over 28 years? None. Okay. This is the reason, because, a fund will fall in and out of favor. Sometimes it'll do badly. Sometimes it'll do well. In the long run, if the fund has strong fundamentals, right? If there's a solid fund management team, if the AMC has a good pedigree, they will ride out these phases. And in the long run, all these things will get averaged out. So I've strongly discouraged investors from trying to pick the best performing flavor of the month fund over the next quarter, month, year, and just stick with funds that have very strong fundamentals. So I'm a big fan of evaluating a particular equity fund from a qualitative framework rather than quantitative based on metrics and numbers.
Great. So I do have some more questions on the qualitative framework. But before that, viewers, if you are enjoying the content, do share your likes and comments. And if you have any questions in your mind, do drop that in the chat box and we shall take it up once the session is done. So Anirudh, my next question to you is, of course, a continuation from what you just spoke about. the qualitative framework. Could you please elaborate a little more on that for our viewers?
Sure. So I think risk management is very, very important, right? So the first thing we look at least in a particular AMC, I said we like to evaluate funds top down from the AMC level, is that particular AMC's risk management framework. How empowered is the risk management team to veto investment decisions, right? Or does a star fund manager have a free hand to just do whatever he or she wants? And while that can pay off richly at times, if a speculative bet pays off, in the long run, it can work against investors. So the first thing we would look at is a risk management framework that particular AMC or fund has. The second thing I would look at is how has the fund performed in the bad times. So instead of looking at the best quarter return or the best month return, I would actually go back and see, okay, here are the worst phases for equities. Here was 2008. Here was 2020. Here was demonetization. Here are the worst phases. How did the fund perform during that time? What investment decisions did it take? Was it sitting on cash adequately at that point? Was it able to deploy more money? Right? Was it true to label? True to label means if it's a large cap, I would like most of my stocks to be large cap in that portfolio. I would not want that fund manager to take excessive calls outside the space of large cap, right? Because I, as an investor, have invested in that fund thinking it's a large cap. Now, unfortunately, what happens is sometimes large cap funds do end up taking a higher mid cap or small cap allocation, which does well. And that creates that aberration of outperformance, that whole 1 year return or 2 year return kind of aberration. And it ultimately, investors go in thinking this is an outperformer, but it may have outperformed in the short run because it went outside its framework, right? So
I'm sorry to interrupt here. So in that case, do you think such sudden short-term outperformance is a red flag, or do you think it could be an opportunity as well?
It's a definite red flag. I know a lot of things that I'm saying fly in the face of what a lot of people would like to hear or what they have gotten around to believing. For us, if something is shooting up, we become very, very circumspect. It is a red flag for us. We'd like to dig deeper and figure out where that extra outperformance is coming from. I'll give you an example. There was a small cap fund 3-4 years back which was rallying, and a lot of our clients came and said, okay, why aren't you giving us this fund? When we dug deeper, we realized it ran an extremely concentrated portfolio. I think around 19 odd stocks, right? So 19 small cap stocks. Small caps are in any case high risk. Now, when you add that, when you add the fact that that particular portfolio was so super concentrated, the risks did not justify that incremental return, right? Because like I said, a lot of our clients, they're new. And a lot of future clients will be new in this particular space, right? So what we don't want is to sour their investing experience. We want them to continue to have faith in mutual funds and industry. And for that, you can't just get them into a 19 stock small cap portfolio just because it's outperformed the rest of the pack without understanding the risk. So to answer your question, yes, short-term speedy returns are an aberration. We would in fact dig very deep and figure out whether that's actually coming from sticking true to label and some value unlocking happening. So I'm not saying it's always a red flag. I'm saying it needs deeper looking in. Right? Have risks been exponentially increased in order to achieve that return? Is it coming from just one stock? And basically, I know there was a fund which did exceedingly well back in my early days. Was it 2005 or 6? It was a mid-cap fund which did very well purely on the back of Unitech, purely on the back of one stock. And it shot up and all the fund houses gave it a 5-star rating. Sorry, all the rating agencies gave it a 5-star rating. And well, the party had to end sometime and then it became a laggard. So that's just an example
of red flag.
That's a classic example. So we would rather, when it comes to equities, like I said, it's a long run journey. It's a long-term investment journey. We would not want to base our decision to invest or not based on a quarter or a year even of outperformance. And it's a red flag. It's something that warrants looking into for sure. Not something that warrants you jumping in with both feet just because it's outperformed. So yes, again, this is a contrarian viewpoint.
Right. You did talk about consistency of fund performance at some point in time as being a criteria for selection. How would you define that? And how can investors find such information, to benefit?
Yeah. So when it comes to equity mutual funds, you're better off with the Rahul Dravids than the Sehwags, to be very honest, because what you want is that the fund avoids big mistakes. I think that's the most important thing, right? If a fund falls in value by 50%, right, as a few debt funds did because they had to take a haircut, it has to grow by 100% just to recover capital, right? And if at that point the index has just fallen by 20-25%, you're probably never going to get your capital back, right? So that's how powerful big mistakes are, especially in the long-term journey. So for us, it's about consistency. We are okay with a fund that doesn't always capture the upside, provided it safeguards the downside, right? So it has to oscillate somewhere in that middle band, that zone of safety. A lot of these metrics are qualitative, whether the fund sticks to the investment philosophy, doesn't chase trends, is true to label, which I already mentioned. Where to get this info? Well, I believe there are some websites that do publish analyst reviews, which talk about these things. Otherwise, of course, an advisor can help you. It is the advisor's role to evaluate these funds from these standpoints. We do talk to AMCs regularly and keep getting these insights, for example, and then we use those to curate our whitelist.
Fantastic. We also come across various ratios and indicators like portfolio turnover ratio, alpha, beta, or standard deviation. What is the significance of these ratios, and how do you think investors can benefit and can use them, in fund selection?
Okay. Well, investors can use them by not looking at them. I think, jokes apart, too much, and like I said, too much information is detrimental, right? And mutual funds are never really meant to be something super complicated. You don't have to be a financial analyst or an MSc in finance to pick a mutual fund, because you've got a team doing that. You've got a star team doing that, right? So why should I spend my entire day looking at metrics like a portfolio turnover ratio, which could mean anything? It could mean that the fund has had a change of strategy. It could mean that SEBI has come out to mandate for which they're having to revise their allocation, right? So if I sit down and try and read into those, it's going to make my head spin, right? Standard deviation, Sharpe, Beta, Trenner, Jensen, sure, they all sound really great. In the end, they don't give you much actionable insight, to be very honest. And the other thing, Shubhana, is most of these metrics are completely meaningless in isolation. And they're also meaningless for new funds. I'll give you an example. So let's talk about alpha and beta, which out of the entire universe of data points, probably give you some sort of insights, again, into past performance. So why I don't preach these too much is all of these are lagging indicators. None of these are leading indicators. The only leading indicators which could be predictive of the future are qualitative, right? While all of these, alpha, beta, Sharpe, Trenner, standard deviation, portfolio turnover, tell me what happened in the past, right? They're like a history lesson. They're not a crystal ball, so to speak. So a quick primer on alpha and beta and how to interpret them if you must. So the default alpha is 0. So alpha is 0 when you've performed exactly as much as the benchmark. If you've performed, let's say, 2% higher than the benchmark, then the alpha is 2. Beta, the default alpha is beta. Beta 1 means my fund is exactly as risky or as volatile as the underlying benchmark. So, for example, if I'm a large cap fund and if I have a beta of 1, that means I've performed exactly the same as, let's say, the S&P, BSE 100 or the Nifty, maybe, whatever it's benchmarked against. Why I say that reading too much into these is meaningless, I'll give you an example. But let me ask you a question first, Shubhana.
Sure.
Okay, so an XYZ fund has an alpha of 2. Is it good?
Again, subjective.
I mean, it's good, right? Because it's outperformed the index by 2% year on year, right? But now, what if it also has a beta of 2?
Yeah, that's what I was saying. I mean, how am I going to be comparing it or benchmarking it against?
Exactly. So you have to understand that returns are a function of risk, right? Now, if a fund has an alpha of 2 and a beta of 1, fabulous. It means it's taken exactly the same risk as the underlying index, but it's delivered a 2% additional return. Now, that's quite phenomenal. But if it has an alpha of 2 and a beta of 2, it means it's twice as risky as the index. Now, is my 2% incremental return worth taking on that much risk?
Yeah.
Because risk works both ways. What's gone up today, when the coin toss is different, we could very well see it coming down. So risk is like that. That's why it's called risk, right? So I would say what matters a lot more than reading into these metrics is to understand risks. For example, if I talk about 3-4 categories, right? So large caps, are the least risky in the universe of equity funds. Then you've got flexi caps, which are slightly more risky, but have the potential to deliver higher returns. Small and mid caps, spectacularly risky. I myself have had my own portfolio in small caps fall by 60%, right? And being in the industry, have had to grapple with a lot of behavioral biases at that point. Like, should I get out? Is it going to get worse? Then there are sectoral and thematic funds, international funds. All of these are, again, higher risk because, for example, international funds also carry a currency risk, right? And they're investing in a market which is different from mine. Sectoral funds are concentrated into one particular sector. So I'm completely dependent on that one sector doing well. If for some reason it doesn't do well, then everything's going to go south. So I think it's very important, once you've understood and defined your goals, is to understand risk and the interplay of risk and reward. If you've done that, then the process of selecting funds becomes a lot easier. If you've done that, and if you've said, okay, these are the AMCs that I think I have a strong belief in, and within these AMCs, I believe that this is the amount of risk I'm willing to take, right? So that framework is a much clearer framework for deciding which fund to invest into, rather than jumping in and saying, okay, let me sort all equity funds by 2-year return, and wow, okay, this pharma fund is given 46%, must be fabulous, let me park my entire money into it. So now you understand how that framework is detrimental, whereas this, where I start with goals and I move to AMC, I educate myself on risk, and I say, okay, this is my retirement goal. I'm okay with a 40% downside. If I'm going to get a 13-14% CAGR over the next 30 years, all right, it's worth it, right? So suddenly I've transformed myself into a potentially more successful investor.
Absolutely. Guys, we do have some more interesting questions coming up, but this is a reminder, if you are liking the content, do share your likes and comments and the questions in your chat box. We will be waiting for your questions and we'll take them up after the session. So Anirudh, you have been talking about behavior biases for a while now. I would really love to know, or I would really love to listen to some of the experiences you might have had when you were talking to your clients over the phone, and how did you even manage those biases?
So many of them, right? So the most recent example, of course, is what happened during the pandemic, right? People saw their hard-earned savings fall by 40-50% in a matter of a month, right? And we saw a very clear difference between the way a goal-oriented investor thinks and the way an ad hoc investor thinks, right? Your immediate focus shifts at that point to limiting your downside if you're an ad hoc investor, which, when it comes to equity investing, is not always the best strategy, because if you're too fixated on limiting the downside, you're going to end up fence sitting, trying to time the market, doing all these kinds of things, and in the end, you'll earn zero or negative. There are actually people who booked out at a 10,000 Nifty and kind of sat all the way while the markets rallied to 18,000. And that happens because, when a train is moving at bullet speed, you just don't know when to jump back in. So I think any kind of catastrophe or any kind of euphoria, any extreme emotion, and of course, coupled with news and so much information, does incite a lot of these behavioral biases, and it distorts our judgment, and it limits our ability to select the right fund and to stay put. There have been phases, again, I remember a phase, I don't remember exactly when SIP returns over 3 years were 0%. Right? So a lot of clients rightfully were frustrated. They said, okay, but you made my goal-based projections based on 12%. Why am I at 0%? And we did explain that equity returns are not linear, and you have to just stay put. A lot of people listened, a lot of people didn't, but those who listened, they were part of a rally which saw that CAGR of 0 move to a CAGR of 14% in a matter of a month.
Wow.
So that's how equity investing works. And one has to understand that. And you can't really predict when that return level comes. You can only manage risk, and you can only stay invested for the long term based on your goal. And occasionally, of course, fine tune your engine. I'm not saying you should just be completely passive. No, it is important to go back once in a while and see, okay, has my fund become a consistent laggard? Is it always in that bottom quartile? Has there been some massive change in the AMC at the fund management level? These are questions one should periodically ask while evaluating an equity fund portfolio.
Right. What are your top words of advice for those investors who want to invest directly?
Okay. So it's not a bad option to invest directly if you're savvy, if you understand all the things I said in the last half an hour, if you understand how equities work, if you have the time to manage your own portfolio, it's not a bad idea. It's not a bad option at all. You will save a little bit of you will save a little bit of money. What I would suggest is, first, don't pile up on NFOs. Don't buy on tips. Don't over diversify. When you're investing directly, it becomes very easy to become like an excited child in a supermarket and say, "Oh, this NFO, that NFO. My friend suggests this. Isme 5,000 dal deta hu. I'll put 10,000 there," and then you end up with a portfolio that's so cluttered and over diversified and unmanageable, and you don't know whether you're coming or going. You don't even know if you've outperformed the benchmark, or has all that just been for nothing. I would say, even if you're going direct, please define your goals and objectives. Don't be an ad hoc investor. Figure out why you're investing. Educate yourself on risks and on correct investing principles. You may want to start an STP. You may do an SIP. Sometimes it may be the right time to be in guilds. Sometimes you may need to do a lump sum. So it's important to be educated on these. And of course, select funds that have an established track record across cycles, right? So not fly by night, not those short-term heroes, not the Sevags. Go out there and pick those Dravids and then just be happy. Sleep peacefully at night, knowing that you're not going to make any big mistakes. I think that's very important, that your portfolio shouldn't keep you up at night.
Right. And any advice for those investors who have not yet set clear financial goals for themselves, and how do they, move on with their investment decisions?
I think they should introspect or meditate or something.
Okay, absolutely.
Everyone's got goals. We've all got goals. Unless you're either super rich and you've got so much money that then you don't have goals, and your goal is to just manage that money, or you are so self-realized that you have no desires in life. Either these are the only two situations where you don't have goals. Either if you're not in any of these two extremes, you probably just need to introspect and figure out what those goals are and define them, with or without an advisor.
So it's
Speak to your spouse. Speak to your spouse. Sometimes a brainstorming session helps. Okay, this is what I want to put aside for my kids. This is what I think we should have for our retirement. We want to buy a new car. We want to maybe upgrade our house. All these are financial goals. Go on a foreign trip. It doesn't matter. It doesn't have to be a serious goal every time.
Great. So one should have a good, their financial goals sorted before they start investing, is the message that you would want to give.
Definitely.
So also, Anirudh, I do conduct a lot of financial wellness sessions across different corporates. And a very common question that I'm getting is about index funds. What's your view on index funds?
So index funds are not a bad option at all. In fact, I personally believe that in over the next 5-7 years, we will see a very massive shift towards index funds. I do believe that. The only reason why it's not picked up as much as it has, let's say, in the US or other developed markets, is because there's still a lot of information asymmetry, which allows value funds or small cap funds to outperform. But if you put an index fund beside let's say a large cap fund, a plain vanilla large cap, you'll see probably very little outperformance. So you may not see outperformance at all, even over 3, 4, 5-year horizons. So it's becoming exceedingly difficult for a fund manager who just got 100 stocks to invest into to outperform an index, right? Because the universe of choices is limited. And so if you're a large cap investor, pure large cap investor, go for an index fund. But if you want to move away from index, pure large caps, and also invest into, let's say, small caps, sectors, themes, other funds like, let's say, BAFs, which are balanced advantage funds, then of course there's not an index for those. So index funds are great, but they don't cover the entire gamut of financial objectives. So I'd say they are a very solid replacement for large caps as of now. Maybe going forward in the next 5-7 years, they will also be able to usurp mid and small cap funds and come at par with them in terms of outperformance, but that's not the case right now. So as of now, it's probably a valid replacement for a blue chip fund. Beyond that, you've got to move away from index funds and look at other options. For example, if you've got a 4-year goal and you want to take moderate risk, there's no index fund for that. You've got to go into a BAF.
Right. So could be a good alternative for people who have just started their investment journey, could be.
Yes and no. So yes, maybe to get a decent taste of how equity investing works. But even someone who's just started why wouldn't they start a 500 or 1,000 rupees SIP in a small cap for their retirement? It's all about educating yourself. right? It's all about understanding the interplay of risk and reward. So I would not completely agree with that. While yes, there's a valid point, I would say yes, sure, invest in index funds, but also for my retirement, I've got all my SIPs running only in small caps. And I'm willing to see that fall by 40% because I know in the long run, it's going to give me a 14-15% CAGR. And I know how compounding is going to impact that final corpus. That difference between an 11% and a 15% compounded over 30 years is massive.
Absolutely. So Anirudh, thanks so much for sharing your valuable insights on equity fund selection criteria today. So to sum it up, you suggest one should identify and align their financial goals before they invest, know their risk appetite before investing in any funds, and look at parameters like rolling returns, investment framework, how are funds performing in bad times, and of course, fund managers' pedigree as well, before selecting equity funds in addition to past performance. Please add if I would have missed out any of these key takeaways.
I think you've covered everything to the T. So
thank you. So time for some questions that have been popping in my chat box. So let me read that out for you, Anirudh.
Sure.
So the first question is, if past returns are not the main criteria, then what are the other statistical facts or criteria that an investor should look at? Some of the points, of course, you covered, but just in case if you would want to highlight.
Yeah, so past returns are not something to be ignored, like I said already. Just don't look at it in isolation. Look at it in terms of rolling returns. Look at it in terms of outperformance over the benchmark, and just give that number more meaning, is what I'm trying to say. Don't just look at a 1 or 2 year return. Evaluate, sure, based on past returns. But if that past return has come from an AMC, which is very new and which has a questionable fund management philosophy, I would say that's a no-go, despite having a good past return. Because like I said, past returns are lagging indicators, whereas AMC pedigree, fund management strength, and all these are qualitative and future, right? They're more futuristic.
Absolutely. Moving on to the next question, how to create or diversify passive-only portfolio for long-term investments of up to 15 years.
A passive portfolio, you said?
Yes, a passive-only portfolio. Is it possible, or even if someone wants to try, how do you suggest one can do that?
Well, if you're only going to have passives in your portfolio, I'd say you will be unfortunately missing out on a lot, right? At this point, I keep saying that at this point because information asymmetry is shrinking. And I think in the next 5-7 years, we may very well reach a point where only passives make sense, but we're not there right now. So I'll flip your question and say, don't just have passives in your portfolio, have passives to an extent, have 20-30% in passives, but follow a core and satellite strategy, have 30-odd% in passives. But the rest should be in actively managed funds right now. Not necessarily blue chips or large caps, but there's a very large universe of stocks in India right now. So why not benefit from that? Why do you want to give up that potential 3-4% extra that could come from there? I would say follow a core and satellite, mix passives with actives right now. And that's the best strategy for the next 15 years.
Right. Anirudh, what is the AUM one needs to consider while picking up funds? We did speak about a lot of parameters, but if you can also highlight if AUM could be an important parameter.
Not really. So, of course, you don't want to get into a fund which has a 20-30 crore AUM, has just been launched. There is no real sweet spot. I know that there's been talk about mid and small cap funds starting to underperform once they've reached a certain threshold. But then what happens now is a lot of these funds, they shut themselves off for future subscription, right? When they feel that there are no opportunities left at this point, right? So again, not something we fixated at too much, but yes, I would say avoid a fund that, let's say, has an AUM of less than 500 crores or 1,000 crores, because then it's really, really small. And stick to that sweet spot between, let's say, 1,000 crores and 20,000 crores, which is the universe of most long-term performing funds.
Great. The next question is, of course, quite a common one. I'm going to be blending two questions. Ideally, how much of allocation should one have in large, mid, and small cap funds? And typically, how many funds should one hold in his or her portfolio?
Okay. So again, depends completely on your objectives, right? So don't fall for those bogus frameworks like 100 minus age and all that. I really don't believe in them. once you define your goals, it becomes so much easier, right? Then it could be that you need 100% in small caps. I don't know. If all your goals are long term, if you understand how risk works, if you don't need any money at all, if you've got a solid emergency fund, solid running income, great asset base, rental income, why do you need to look beyond small caps at all? Right? If all your goals are 10-year plus. So I would say the asset allocation question is more applicable to an HNI who's got a very large portfolio and doesn't need to meet any financial objectives. Anyone who's accumulating, they need to look beyond this standard model of asset allocation and look at what is the optimal risk that they can tolerate and what is the risk they can build into each goal. Now, if you are someone who's already got a large corpus, there is again no fixed formula, but at this point, I would say maybe 20-25% in large caps, 30-35% in small and mid, and the rest can be cash plays or sectoral and thematic plays as well.
All right. My last question to you would be, where can you get information on risk management setup of AMCs?
Very difficult. So unfortunately, that is only possible once you are in a position to talk to AMCs and to engage with them. I don't think that information is there in the public domain. So any good wealth manager or advisor or financial advisor, intermediary who engages with an AMC will be in a much better position to give you this information.
Right. Thank you so much, Anirudh. Guys, if you need help selecting the right equity funds, do DM us on Instagram or leave a comment behind on the YouTube stream, and we will connect with you ASAP. We also recommend that you visit our website, www.dspim.com, and use the personalized recommendation tool. It is a complimentary tool for everyone, whether you are an investor or not. And it will just take you 5 minutes to understand yourself better and your risk profile as well. I'm going to share the link on the bio on Instagram and also in the YouTube description for your reference. Anirudh, thanks once again for sharing your valuable insights, and it was a pleasure having you in the show. To all my viewers, have a good evening and happy investing to all of you.
Thanks, Shimona.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.